video, we'll discuss the 3 steps used to prepare the statement of cash flows and elaborate on the first step. The second part of this video will cover steps number 2 and 3. Preparing the statement of cash flows involves 3 major steps. The first step is to convert net income from an accrual basis to a cash basis. You will need to analyze the current year income statement as well as a comparative balance sheet. More specifically, most non-cash current assets and liabilities, such as accounts receivable, inventory, accounts payable, and wages payable. Of course, there are always exceptions, such as you want to exclude any short-term investments because that would be considered an investing activity, and any amounts owed to a financial institution because that would be considered a financing activity. Step 2 involves analyzing a comparative balance sheet as well as selected additional information to determine their effects on cash. More specifically, we're going to analyze changes in non-current or long-term assets and liabilities accounts as well as stockholders' equity accounts. We're going to record those changes as investing and financing activities, or if in the event they are a non-cash transaction, we will disclose that. The last step, or step 3, compares the net change in cash on the statement of cash flows with the change in cash reported on the balance sheet. The difference between the beginning and ending balance is the net increase or decrease for the period. We will prepare a statement of cash flows for Computer Services Company. So we will need their current and previous year balance sheets or comparative balance sheet, their current year income statement, as well as related financial information for the current year. This is the current year income statement for Computer Services Company. The net cash inflow or outflow for the year is the same amount as the increase or decrease in cash on the balance sheet. So we know that Computer Services Company's cash increased by $22,000. Preparing the statement of cash flows requires an analysis of the balance sheet. And I want you to focus on the change that occurs in each balance sheet account. When we prepare the statement of cash flows, we're relying on a simple manipulation of the balance sheet equation. Again, if you remember from financial accounting, our assets must equal our liabilities plus our stockholders' equity. We can manipulate that equation and write it this way. We can say that the change in cash has to equal the change in liabilities plus the change in stockholders' equity minus any change in non-cash assets. As a result, any transaction that changes cash must be accompanied by a change in liabilities, stockholders' equity, or non-cash assets. And that's why we need a comparative balance sheet. As I just stated, preparing the cash flow statement requires an analysis of the balance sheet. We focus on the change that occurs in each balance sheet account. I just want to remind or warn students that you need to use the additional information to help explain the change. For example, we can see that bonds payable increased by $110,000. If we go to the additional information, more specifically number 3, we can see that the company issued $110,000 of bonds in exchange for land. This is actually an example of a significant non-cash activity, and we would not report this in the statement of cash flows. Instead, the company will report this activity in a separate schedule at the bottom of the statement of cash flows or in a separate note. And then the last thing I want to mention is that equipment increased by $17,000. You don't see it on this slide because this slide is focused on liabilities and stockholders' equity. It's actually on the previous slide where we showed the assets. The point I want to make here is that the change in assets was $17,000, but if you look at the additional information, you can see that in number 2 and number 4, right, the company actually purchased new equipment for $25,000 and they sold equipment with a cost of $8,000. So it's really important that you use the additional information to help you explain the change that occurs in each account. Okay, so we know that any transaction that changes cash must be accompanied by a change in liabilities, stockholders' equity, or non-cash assets. So we can follow the general guidelines when we prepare the statement of cash flows. Operating activities will involve income statement items such as net income and depreciation, but we're also going to look at the change that occurs in non-cash current assets and current liabilities, such as accounts receivable and accounts payable. Investing activities are going to involve cash flows resulting from changes in investments and long-term assets, such as property, plant, and equipment. And finally, the last one, our financing activities, will involve cash flows resulting from changes in long-term liabilities as well as stockholders' equity accounts. The exception is retained earnings. And if you remember from financial accounting, retained earnings is going to increase for net income, but we're going to actually reduce it for any dividends. Net income is considered an operating activity, whereas dividends is considered a financing activity. So when you look at the balance sheet, rather than think of each line item as an asset, a liability, or stockholders' equity, I'd like you to think about them as an operating, investing, or financing activity. Let's look at current assets. We have accounts receivable, inventory, and prepaid expenses. These amounts are results from our ongoing operations, so I'd like you to think of these as operating activities. Whereas property, plant, and equipment represents an investing activity. Again, if we purchase equipment or if we sell it, in either case, these are considered investing activities. And then the only thing I want to note is that the current year depreciation expense will increase accumulated depreciation. And this account will decrease when a sale occurs, such as a piece of equipment. Right, let's look at our liabilities and stockholders' equity accounts. Again, if we take a look at our current liabilities, we have both accounts payable and income tax payables. And again, I want you to think of these amounts resulting from our ongoing operations, so they are considered an operating activity. Right? We have an increase in both bonds payable and common stock. Again, I want you to think of these as our financing activities. Again, how did we choose to finance our operations? Did we issue debt in the form of bonds payable, or did we issue stock, which would see a change in our common stock account? And then lastly, we have our retained earnings. And when it comes to the change in retained earnings, I want you to think of it's mixed in that it contains both an operating as well as a financing activity. Right? We consider net income operating activity, whereas the payment of dividends is considered a financing activity. To determine net cash provided by operating activities under the indirect method, companies adjust net income. Before we talk about the adjustments, I'd like to discuss why net income must be converted from an accrual basis to a cash basis, or net cash provided by operating activities. Under GAAP, most companies use the accrual basis of accounting, which requires a company to record revenue when it is earned and record expenses when incurred, regardless of the timing of cash receipts or cash disbursements. Revenues include credit sales for which the company has not yet collected cash. Expenses incurred include some items that it has not yet paid in cash. Under the accrual basis of accounting, net income is not the same as net cash provided by operating activities. The indirect method starts with net income and converts it to cash flows from operating activities, or a cash basis, by making 3 adjustments. We'll discuss each of these adjustments in detail in the next few slides. We need to adjust net income for non-cash expenses such as depreciation. Recording depreciation expense does not affect the cash account. It actually affects a non-current investing asset, such as property, plant, and equipment. Again, if you want to think back to financial accounting and the journal entry for depreciation expense, you debited depreciation expense and credited accumulated depreciation. Again, there was no impact on our cash account. Since depreciation is subtracted from net income, we always add it back to convert net income to cash flow from operating activities. Remember, depreciation is simply the process of allocating the cost of a building or piece of equipment over their productive lives using a systematic and rational method. Computer Services reported depreciation expense of $6,000 for building and $3,000 for equipment, so they will need to add back $9,000. And again, they're going to add that to the net income of $145,000. All right, the next adjustment is we need to add losses and subtract gains on the disposal of plant assets. If a company sold property, plant, and equipment at a gain or loss, the amount of cash received would be classified as an investing cash inflow. Since all of the cash received is an investing cash flow, an adjustment must be made in the operating activities section to avoid double counting the gain or loss. Losses on sale of property, plant, and equipment are added, and gains on such sales are subtracted to convert net income to cash flow from operating activities. We know the company sold equipment with a book value of $7,000. Again, the cost was $8,000 and the accumulated depreciation was $1,000. And we sold it for $4,000 cash, so they had a loss of $3,000. So we need to add back the loss on disposal of plant assets. The last step to reconcile net income to net cash provided by operating activities involves examining all changes in non-cash current assets, except for short-term investments, and current liability accounts other than amounts owed to financial institutions. The accrual accounting process records revenue when earned and expenses in the period incurred. We need to adjust net income for these accruals and prepayments to determine net cash provided by operating activities. We can apply the following general rules. Add the change when an operating asset decreases or an operating liability increases, and subtract the change when an operating asset increases or an operating liability decreases. This table summarizes how to adjust net income for changes in non-cash current assets and current liabilities. All right, so we know that our accounts receivable decreased, which means we're going to add $10,000. Our inventory increased, so we're going to subtract $5,000. Our prepaid expenses increased, so you'll subtract that, whereas our accounts payable increased, so you're going to add that back to net income. And lastly, our income tax payable decreased, so you're going to subtract that from income. Again, if you add all these adjustments, you will arrive at the net cash provided by operating activities of $172,000. This slide is a great resource that summarizes the three adjustments that we just discussed. The statement of cash flows prepared by the indirect method starts with net income, and then items which are noted in this slide are either added or subtracted to arrive at the net cash provided by operating activities. I have one last comment that I want to make on the change that occurs in assets and liabilities. And again, this is to help you remember the adjustment. And if it doesn't help, then just go back to this table and essentially memorize this. But what I want you to think of is the accounting equation must remain in balance. So assets must equal liabilities plus our stockholders' equity. If a company receives cash from a customer, that means our cash is going to increase. If our accounting equation is going to remain in balance, then our receivables has to decrease. So again, the assets are going to have an opposite effect on cash, meaning if cash goes up, assets will go down. That's why when you see those changes and increase in a current asset, means we're actually going to deduct or subtract that from net income. The reverse is true. If there's a decrease in our current assets, we're actually going to add or increase net income. Liabilities, however, have the same effect or going to move in the same direction. In other words, if a liability decreases because we paid a supplier, then you're going to see your cash go down as well as your liabilities. And you can see that when it comes to those changes, we're moving in the same direction. In other words, if a liability increases, we're also going to increase net income or add it to net income, whereas if a liability decreases, we're going to decrease net income or deduct that amount from net income.